From the Land Grant University in Urbana-Champaign, Illinois, this is the Closing Market Report. Happy Thanksgiving. Coming up, we'll hear a portion of our Commodity Week program. Actually, just one of the three analysts that we interviewed for that program will appear today, Matt Darragh. He is with Kpler and has a very interesting story as it's related to trade, policy, and the movement of grain across the planet. We think you'll be interested in that on this Thursday edition of the Closing Market Report that comes to you from Illinois Public Media. It is public radio for the farming world online on demand at willag.org, willag.org.
Todd Gleason services are made available to WILL by University of Illinois Extension.
Matt Darragh now joins us from the United Kingdom. He is with Kpler. To remind you, we've talked to a few folks from Kpler from time to time, from Dubai and other places. They are a transportation and freight company, intelligence that is following those sorts of things and how global commodities move across the planet. Now, Matt specializes, I believe, in commodity markets, corn, soybeans, and wheat. Hi, Matt. Thank you for being with us. Where in the United Kingdom are you?
So I'm based in England, in the West Midlands, so fairly central, in amongst most of our arable production.
Okay. Well, how did the growing season there go? We don't talk very much about the United Kingdom, but just out of interest, how did the growing season last summer go?
Relatively favourable, I think. On the whole, more favourable than we had perhaps 2 years ago and the year before, I'd say. Generally benign weather conditions across the board, which has really helped to establish our wheat crop. We are expecting to see a little bit of a contraction on our sort of barley area, but I think wheat is still very much in the rotation, and we perhaps might be seeing a larger oilseed rape area as well this year. But on the whole, generally growing conditions have been favourable so far as we head into dormancy.
Remind me what it is Kpler does and why.
Of course, yeah. So Kpler is mostly a cargo tracking company. So we provide real-time information with regard to the volume of cargoes tracked across a number of commodity markets, from major exporters to major importers. And this can give users a real-time understanding of exports across a number of commodities that covers energy and dry bulk commodities such as grains and oilseeds. And then also there's a second vertical there, which is the insights package. So alongside the cargo tracking side of things, we also offer research analysts, which some users find useful in regards to understanding the context behind why we're seeing those cargo flows.
And I suppose this is where the intersection comes between freight and what you do as it relates to commodities such as corn, soybeans, and wheat?
Absolutely. Yeah, absolutely that. So we can help users understand why we're seeing the volume of Brazilian soybeans head to China and why we might not be seeing the same kind of volume from a seasonality point of view of US soybean to China.
Well, what did you tell them early on about this?
Yes, it's a good place to start, I suppose. We started out the year back in April when we saw that kind of sort of breakdown in favourable trade ties between the US and China. At the start of the year, we were quite pessimistic with regards to US soybean exports to China. In fact, we were one of the first research analysts to put out our estimate we were one of the first research analysts to forecast zero US soybeans to China for the 25-26 trade year, which obviously is quite at the time, we were looking quite far ahead there. But when we looked at the fundamentals, we saw that we had this huge South American soybean crop coming online. And we didn't see China necessarily requiring US soybeans in 25-26 off the back of the supply it already had available, and also taking into account its current reserves. Of course, present day, we are now seeing US soybeans be purchased by China, but and we've adjusted our forecasts accordingly. But we're still quite hesitant with regard to whether that 12 million ton sales commitment will be reached. Of course, this is what the US has put out there, but it's yet to be acknowledged by China. And of course, I appreciate there's a number of analysts in the market there who are doing the numbers here, but So 4 weeks have passed since we had that meeting between the US and China and South Korea, where we heard of this 12 million ton quote because the commitment be announced. And of course, I think we're just over 2 million tons, so we're somewhere around a quarter of that commitment being reached, but we only have 5 weeks left until the end of the calendar year, of which is when China was meant to have reached that 12 million ton commitment. So there's a little bit of concern in the market there that this commitment won't be met. And this is something that we are suggesting to our clients, is that we don't think it will be reached. And we're concerned about the impact this is having on the 2026 soy corn ratio, because at the moment there's a signal there. I think I was looking at the ratio earlier today, we're about 2.4. So it's moving more towards, from where it was a few months ago, it's moving more towards soybean planting. But this is off the back of assuming we reach that commitment from China to purchase the purchase of soybeans. So there's a danger there that if China doesn't purchase the soybeans that it's supposedly committed to, that the US will produce a larger soybean crop, and come 2026, they'll be requiring, might be again on the phone to China asking for more soybean sales.
There are a couple of questions I have for some clarification's sake. As you talk about the marketing year of 25-26, do you think that China will make the total 12 million metric tons for the full marketing year as opposed to by the end of the calendar year, or using a different number for the marketing year?
We don't see China reaching 12 million tons for the full marketing year. So for 25-26, our current estimate is below 12 million tons, and we may revise this even lower, depending on how we see things develop in the coming weeks. And just for further context, for 26-27, we still are a little bit unsure as to whether that I appreciate the 25 million ton commitment was a calendar year, but we're still unsure that we'll see 25 million tons of US soybean exports to China in 26-27 as well.
Okay, so given that set of numbers and the ratio that has changed because the price of soybeans has outpaced on the commodity markets at the CME Group the rise in the price of corn, what are you telling your end users as it's related to the intelligence and where the market might be headed?
We're sort of informing our users that the US corn export campaign will be very important. Of course, in the sense of we're off the back of a very strong export campaign at the moment, and we're still expecting this to continue. And also, the strength of this export campaign is very key with regards to where this will see corn ending stocks come the end of the 25-26 marketing year. And if we don't see an improvement with regards to US soybean exports to China, therefore we might see greater corn planting, and as a result, or we may see corn acreage staying at historically high levels, which could lead us to a continued supply pressure with the US corn market. For the US soybean market, we're informing our clients that we are seeing very elevated crush demand in the US, and off the back of this, we are seeing a greater domestic supply of US soybean oil and soybean meal, and as a result, that's why we're seeing that weakness in the soybean meal market. Of course, it's improved in recent weeks off the back of increased US soybean sales to China. But nonetheless, historically, that the CBOT soy meal market is still relatively weak. And as a result, we are seeing elevated competition globally for the soybean meal market.
How do you see other nations coming into the marketplace for U.S. soybeans, and will they be able to pick up the slack in exports that you do not see going to China?
Yeah, so this is the concern that we have. It's definitely another point that we've been illustrating to clients, is that when you look at monthly import volumes by destination, China accounts for about 60% of global demand. So therefore, by month, China accounts for more imports than all other nations globally. So the danger there is that the US soybean price has increased off the back of increased Chinese demand. It has now begun losing that demand from alternate export markets. So the likes of Taiwan, Egypt, the Southeast Asia, and North Africa. is where we see some of these countries pivoting back towards Brazil. And as a result, the US soybean export campaign could be in a worse position, because what's happened is Brazil FOB market has begun pricing below the likes of US, and this discount to US origin will only widen once we see that 26 crop come online around February time. So the window for US soybean exports to perhaps dominate the export campaign, the window is narrowing. And the US could actually be in a worse position if this demand from China is not realized, as it's also lost demand from alternate export markets too.
Let me see if I can summarize that correctly. So what you're suggesting is that because China was willing to come into the United States market at a higher price, above what they could actually purchase out of Brazil, make purchases which all were intertwined with the higher price, it priced other nations, which would have been turning to the United States at this point to look elsewhere, potentially buy from Brazil, and that in total, if China does not buy from the United States, will reduce even more fully the number of soybeans that are exported out of the U.S.
Yes, exactly that, Todd. Yeah, and that's the concern that we have currently for the US soybean export campaign for 25-26.
What kind of number then, in that case, are you using for the 25-26 marketing year for soybean exports from the United States in total?
We're around 10 million tons at the moment. In our monthly, we produce monthly balance sheets. So when we published our November balance sheets, we increased our US soybean exports for 25-26 by around 3.2 million tons. So obviously we factored in that increased demand from China, but obviously we've lost demand from alternate origins, which we've already mentioned. So we're around that sort of 10 million ton figure, but if we don't see much an improvement in Chinese demand in the coming weeks with regards to US soybean sales, we're looking to perhaps drop this lower, we're looking to drop this lower, and we'll also need to factor in our forecast with regards to where we see US soybean prices. If we can look to see if we might see more demand from the likes of Mexico or Southeast Asia for US soybeans.
So consequently, when you were talking about the 2.4 to 1 ratio, you expect that to change, and for more corn acres potentially to be sown in the United States and show up in the March USDA report, I suppose?
It's definitely a watch point going forwards. We do expect soybean acres to rise year on year at the moment under current fundamentals. But the concern we have in the market, the concern that we're telling to our users is that if soybean acres rise too much, we may find ourselves in a position of greater US soybean supply, and off the back of an absence of Chinese demand. I think that's the concern that we have at the moment. So we do think in our balance sheets, we do expect US soybean acres to rise year on year for 2026. The concern is just that to what extent, because if that Chinese demand isn't realized, but the market is pricing as if it will happen, this could lead to a greater than necessary soybean acreage expansion, and therefore lead to a greater supply of US soybeans on the market, and lead to a concerning situation in regards to stocks at the turn of the 26-27 marketing year for US.
I'd like to turn your attention to freight and longer-term functions I know that you have been following, particularly the Belt and Road Initiative China has underway, and the port that it is putting on the western side of South America so that soybeans can be shipped out of Brazil, I think through Peru. How might that change the global picture once that port opens, in your opinion?
In our opinion, I think it would have obviously accelerate soybean exports from Brazil to. It would obviously accelerate Brazilian soybean exports to China, and obviously give Brazil a greater advantage to access Chinese demand in the sense of having a tighter window. And I think I'm not too close in the freight market, but I think I would only be able to sort of acknowledge that we would obviously see a smaller window of time for Brazilian soybeans to reach China. And obviously, what this could, in theory, do is usually the US soybean export campaign to China peaks around the time around sort of Q4, Q1 of the calendar year. But if we have a shorter time frame that's required for Brazilian soybeans to be harvested and sent to China, this could narrow the window that the US has to access Chinese demand in a year of lesser Brazilian supply.
That would be an interesting function and drive U.S. soybean exports lower at that point, just closing the window in which the United States might be able to export its soybeans. In the United States, domestic crush, as you know and mentioned earlier, is really on a rip snorter this year. Is that sustainable in your opinion? And will there be demand for bean oil outside of the United States and inside the United States? And how do you see the meal market reacting?
I think we still forecast quite a high utilization for US domestic crush off the back of generally quite obviously very ample supply. And I think for the bean oil market, of course, we're still waiting to hear about from the EPA regarding the reallocation of SREs, which is a key watch point with regards to how that shapes soybean oil demand going forwards. But obviously, it is leading to downward pressure on the meal market. We did forecast that crush demand would rise in the US earlier this year off the back of those more favourable biofuel policies. But we did acknowledge that obviously this would lead to a greater availability of meal within the US, and ultimately leading it quite dependent on a strong export market. Now, this has been challenged by the global situation, of course, where we have an ample fundamental supply of meal across other key major exporters, the likes of Brazil and Argentina. And it's also worth mentioning that off the rather elevated imports of Chinese soybeans. So we recently had Chinese customs for October, and we've had the sixth consecutive month of record high month for the month of soybean imports. And as a result, this is driving crush in China, and as a result, they have almost a much greater supply of soybean oil themselves, which is being exported to export markets, which will take, with one of which is India, where we're seeing elevated Chinese soybean oil exports to India. So as a result of elevated Chinese soybean oil demand, we're seeing that India may not be as present in regard to importing soybean oil from other key export origins, such as Argentina or Brazil, in light of greater supply from China. So there is that challenge there that with regards to how well the US can. There is the challenge there with regards to soybean oil values off the back of a very well supplied global market.
Matt Darragh is with Kpler and a grains and oil seeds analyst for them. Joined us on our Commodity Week program, which you can hear in its totality on our website right now at willag.org, willag.org. Matt was joined for the program by Aaron Curtis and Mike Zuzlo. Again, that's up online at willag.org or in your favorite podcast applications right now as Commodity Week. If you've followed agriculture for long enough, you know that livestock producers have a difficult time making sure that they have proper veterinary care for their animals. Not that they don't take care of them properly, but just having access to a vet or somebody else that is trained and capable. There are just a shortage of them in the same form that there is a shortage of human doctors in rural areas. Large animal veterinarians aren't around as well. Pork producers in the state of Illinois have a unique program that they're working with community colleges on to develop a way to supplement that. Thank you, Jennifer Tyree, who's the executive director at the Illinois Pork Producers Association, for joining me. Can you tell me about this program and its impetus?
Yes, absolutely. So essentially, you think about an apprenticeship and you think of manufacturing jobs. And one of my producers earlier this year said, Jennifer, why don't we have apprenticeship opportunities for livestock industry? And I said, you know what? I don't know. So let me find out. And after doing some research working with the U.S. Department of Labor, we found out that we could develop our very own position called a swine animal care technician, where it would encourage employees to hire community college age students that might be looking to get a little bit more education beyond just coming and working at the farm. They would complete a 1-year livestock certificate. And then after that, during that, they're working at the farm, completing certain competencies. And the goal of this is to develop these employees for long term. We want them to stay at the farm. So we ask each student, they get their tuition covered. Most of their tuition is covered at these community colleges. And then there is a step increase as they complete their competencies. But the goal is to get more employees. A lot of our farms are looking for labor. We've been utilizing the TN visa program for a lot of these employees, but this is allowing us to bring our community college kids back to the farm and get them engaged. Or you can also use this program for your existing employees, and you can give them an additional educational opportunity. So you may have an employee on the farm that wants to better themselves but doesn't want to leave the farm. This gives them that livestock certificate and gives them a little bit more education and gets them to stay and invest in the farm long term.
It gives them well care kinds of functions that they're better able to look at the herd, manage the herd, understand what's happening with the herd.
Yes, animal husbandry is such an important, we're always wanting to make sure we have the best animal care. Animal welfare is very important. And to your point earlier, it is very hard to get large animal vets on farm. And so for us to be able to give these employees that skill set with these swine animal care technicians, then they're built in and they're invested in the daily care of these animals and making sure that we offer the very best product to our consumers.
For producers who are interested in having employees go through the program or looking for employees that are going through the programs, where do they find them?
So they can go to illinoispork.com and look under our youth component, and there is a livestock apprenticeship tab. Currently, we're working with 5 community colleges. We really have them based regionally. We have ICC in East Peoria. We've got John Wood College. We've got Lincoln Land in Springfield, Lakeland in Mattoon, and then Kaskaskia College in Centralia.
Jennifer Tyree is the executive director of the Illinois Pork Producers Association. Join me here at the National Association of Farm Broadcasting Convention in Kansas City.